Investing for the future. It's an issue none of us can afford to ignore. Hardly anyone's job is safe these days. How would you cope if you lost yours? We're all living longer too, so are you saving enough to fund 25 years or more of retirement? Can you really afford to pay for your children or grandchildren to go to university or help them onto the property ladder? And what about all those holidays you promised yourself? We entrust the vast bulk of our investments to fund managers. Here in the UK, according to Her Majesty's Treasury, the industry has more than £4 trillion of investors' money under management. Fund managers invest our savings wherever they see fit, mainly in equities or shares in listed companies. They claim to be experts at making our money grow, at picking the stocks that will outperform the market. But all too often, they disappoint, producing returns that are lower than the average return for a benchmark index such as the FTSE 100 in London or the S&P 500 in the States.
If someone says, I can beat the market, try taking the rate of return achieved by that manager and all other like managers, and you will deduct from it the fees charged, and there are very few who, over a long period of time, do better than the market.
Well, the best study I know of was one carried out in the States over 35 years, from 1970 to 2005. Matt looked at 355 funds. Just 9 of those funds beat the index by 2% or more over that period, and just 3 of them showed sustained outperformance. Now, a study in the UK of 1,200 funds over 3 years, finishing in March of 2011, showed that just 1.3% of those funds were in the top quartile for all 3 successive years.
For veteran investment guru John Bogle, the problem is simple. Fund managers just aren't as smart as they'd like to think they are.
I came into this business when I was at Princeton, and I worked for a brokerage firm in the summer. And one of the old runners said, Bogle, I'm going to tell you everything you need to know if you're going into the investment business. And I said, what's that, Raymond? And he said, nobody knows nothing. And that's true. We don't know what the future holds. We have all these opinions out there, and we've got to say, I'm smarter than everybody else. And that just isn't going to happen.
As it means trading against the view of numerous market participants with superior information, buying or selling a security is effectively just a bet. So, whilst your fund manager might lead you to believe it's his knowledge or intelligence that enables you to beat the market, he's really no better than a gambler.
There's a wonderful human spirit that says, I can do better. That's why we have gambling casinos, which is a marvelous place for people who own the casino to make a very substantial amount of money over a long period of time by entertaining people in the cheerful belief that somehow luck is going to come their way. Same thing's true of investing, that advertisements about investment opportunity always show that there are great successes right around the corner. You could have it too. This could be done for you. You could be a winner. The sad reality is that the quantitative analysis of the hard data would lead to the conclusion that that's just not going to happen very often for very many. And for most people, most of the time, it's going to be just the reverse.
We can't systematically all pick the winner. So the challenge now is, okay, can I find those great active managers? In fact, I don't actually argue there are no great active managers. I'm willing to say, yeah, maybe there are some out there. My problem is I don't know how to identify who they are.
It's absolutely possible for active fund managers to beat the market and to beat the market consistently over time. But there's also the question of probability. And when you assign a probability to a fund manager beating the market consistently over time, it's very, very low.
So you might be lucky enough to choose the right fund manager, but you could just as easily pick the wrong one. According to the financial services company Best Invest, there are currently nearly £10 billion of UK investors' money languishing in what it calls dog funds. In other words, funds which have underperformed their benchmark index for at least 3 consecutive years. Ultimately, of course, fund management companies are businesses. They exist to make money for themselves. They want our business, even if it means persuading us to invest in funds which the managers themselves wouldn't risk putting their own money in.
Occasionally in the tube stations you'll see one of those big posters with Stellar Growth Fund, make your money reach the skies. And I laugh. I look at these and I think, yeah, right, yeah. Honestly, because these funds, they're rubbish. I mean, really, the vast majority of them are rubbish.
They will put out any product that they think the public will buy, whether the companies have any belief that that product is any good, because the idea is to gather assets. The idea is to bring in as much money as you can and manage it. And if that product fails, you could then take that money and convince the client to go into a different product that you're coming out with. Back in the 1990s, the turnover of mutual funds was only about 3% per year. Now it's up to almost 6% per year, so it's almost doubled.
So, to summarise, regardless of the impression they like to give, fund managers regularly produce less than the average market return. Buying and selling shares is little more than a gamble, and strong returns are often down to luck. It's harder than ever before for a manager to outperform the market consistently. Commercial pressure means fund managers often advertise funds they wouldn't choose for themselves. And remember, although there are good managers out there, picking the next star manager is almost impossible. It's now time to look at what it actually costs to invest. Like all businesses, fund managers have overheads. Running a fund management company isn't cheap, especially when the top managers earn around £2 million a year, including bonuses. And remember, it's you, the customer, who picks up the tab. How expensive is active fund management for the manager? In other words, what are they spending your money on?
Well, part of it is actually the costs of research and the costs of trading. The other major component, which is important in any retail fund, is marketing.
To me, most of these investment companies are just purely marketing companies. Let's set up a fund, let's see what we can sell, and it's never really about what's good for the investor, it's about what's good for the investment company.
Ultimately, fund managers need to make a profit. In fact, they're making around £10 billion from us every year, and that's regardless of whether or not they manage to produce a profit for us.
The job of a stockbroker is to transfer the wealth of the client to themselves. Typically, they extract in the range of 2 or 3% of their assets per year from the clients, and if you do that over a period of 20, 30, 40 years, eventually your broker winds up with more of your assets than you do.
We all get a return from the stock market in the long run. Now, let's say for the purpose of argument that that's an 8% return. But we in the markets get the net return after the insanely high costs of financial intermediation. And those can be as much as, say, 2% a year. Wall Street, if you will, in America, gets 70% of the return and puts up none of the capital and takes none of the risk. And we get 30% of the return, we investors as a group, there's no way around this, for putting up 100% of the capital and 100% of the risk. That is just crazy.
Part of the challenge is working out exactly what we are being charged. Investors typically use something called the Annual Total Expense Ratio, or TER, to compare the cost of investing in different funds. But the TER excludes dealing commission, stamp duty and other turnover costs that can add considerably to the expense of investing over time. So, in addition to those hidden charges, what else are we as investors having to pay? And more importantly, what impact do charges have on the value of our investments in the long term?
You might be looking at 1.5% per annum or more in management fees. It doesn't sound very much, but if you're talking about an investment strategy lasting over 20 years, it's a large amount of money that you're actually paying over to the fund manager, and you want to make sure that if you are doing that, you're getting what you're paying for.
Studies
are being carried out, and the FSA is very active in this, on emphasising that one of the main determinants of longer run wealth destruction is the charges. Now, people tend to underestimate the effect of, say, a 1, 2 or 3% charge each year is a very substantial reduction in the wealth.
And the bad news doesn't stop there. Despite a marked increase in competition, management charges in the UK have been steadily rising over the last 10 years.
Charges are an insidious component of the investment proposition, and you know, for every pound that you pay out in charges is a pound that doesn't go into your pocket, which compounds over time. And what we've actually seen, and recent research shows, is that fees in the UK are actually going up rather than going down as they are in the States, and at an absolute level they're higher than they are in the States. And you know, I think there's a lot of talk about charges and fees and fee structures, the impact of fees. This is an argument that they've been having in the States for a long, long time, but it's only just really beginning to be held seriously in the UK.
There are some encouraging signs for consumers. The FSA's Retail Distribution Review will require fund managers to be fairer and more transparent when it comes to charges. In the meantime, investors should be on their guard.
I don't think the financial services industry cares really about just how much the general population despises and distrusts them. They have really not learnt the lessons that they should have learnt. I think it's endemic, actually, to the financial services industry that they lie, they dissimulate, they use smoke and mirrors to make us think that something's going to make us money when in fact it's going to make them money. We are very cynical, and frankly we are right to be cynical.
So, in summary, fund managers have large overheads, not least salaries and bonuses, and you pay the bill. Over time, charges that sound modest can seriously erode your savings. Many of the charges that consumers incur are hidden in the small print. And to add insult to injury, fund management charges have been rising year on year. So conventional active investing, in other words, paying someone to pick your investments and decide when to buy and sell, is expensive. And as we've also heard, only very few managers are able to outperform the market consistently. But is there an alternative? A strategy that costs us less but produces a higher than average return after costs in the long run? Yes, there is. It's called passive investing.
Passive investing is really more about the vehicles of choice for a given investor. So it's about using index funds as opposed to trying to select active managers that may or may not ultimately best their market benchmark.
If you take a passive fund that's going to follow the FTSE 100, the person running that fund buys shares in every single one of the 100 companies within the FTSE 100. So it directly follows or replicates the index, is sort of the jargon that's used, as opposed to an active manager who will say, I'll only pick 20 shares, which I think are the best 20 in the FTSE 100. You're then relying on the skill of that fund manager to find the best 20.
Mathematics tells us that the average active investor and the average passive investor in a market where all of those investors equal the market should earn identical returns net of fees. Now, when we subtract the fees from those products, what we see is because passive funds are inherently less costly to operate, they tend to outperform active funds over time.
Although it accounts for only a small share of the wealth management industry in the UK, passive investing is much more popular in the United States. American academics have made a compelling case for it since the 1950s. In the 60s, economist William Sharpe developed the capital asset pricing model, for which he was later awarded a Nobel Prize.
It has to do with the relationship between the price of a security, its risks, and its expected return. And there are really sort of two key takeaways, if you will. One is that in that setting, the most efficient strategy for an investor is to hold basically a broadly diversified portfolio reflecting the market of securities that are available. And that gave birth to the notion of index funds. And the second is that there will be a reward in higher expected return, not guaranteed, but expected, for bearing risk. But the kind of risk for which the reward should be available is the risk of doing badly in bad times.
After the capital asset pricing model came the efficient market theory, developed by Eugene Farmer and Ken French. The idea being that shares are always priced correctly because they already reflect everything that's publicly known about a company. More and more Americans were beginning to realise that paying a manager to buy and sell individual shares was a waste of time and money.
Market efficiency is the idea that market prices adjust very quickly to new information. And theoretically, one would believe that market prices would incorporate all the known information that's available. And so if that is mostly true, which I think it is, then it's very unlikely that any investment manager or investment fund or group will be able to have the knowledge and information to consistently take advantage of market errors.
That doesn't say that other investors are stupid when they go out and hire active. What it says is if there is somebody who hires a successful active manager, there must be somebody else who's hiring an inferior active manager.
Weston Wellington used to work for a firm of active fund managers, but the more he read about the evidence in favour of passive investing, the more it made sense.
Almost everybody who adopts this particular investment viewpoint undergoes a similar journey, because for most people the only definition of investment advice is trying to forecast the future in some way. Which stocks will do the best, which managements are the best, which countries are the best to invest in, and so on. And it takes a while to understand that there might be a more useful alternative. Now, my particular journey was a function of first 15 years or so doing it the conventional way, reading all the usual sources and listening to all the usual experts and never really questioning it. But then when I had to undertake a position of making these decisions myself, I was the research director in charge of developing model portfolios, and I was going to be held accountable for the performance of the various managers I selected. And I had to keep track of what my performance was. When someone starts to keep track of what your recommendations are, it's a bit humbling to discover, well, maybe you weren't quite as smart as you thought you were.
It was while working as an investment specialist in New York that Tim Hale came to the same conclusion. He believes that many active managers happily gamble with other people's savings while quietly investing their own money in index funds.
A quick example was when I first arrived there, was trying to put forward together an investment performance track record for the firm that I was working for, and ultimately, being unable to find consistent performance, within the data that we had, and I think that began to sow the seeds of doubt in my mind. My pension plan was full of passive investments, which I think is quite a telling sort of indication of, I guess, the increasing cynicism.
Although public awareness of the advantages of passive investing is very much lower here in the UK than it is in the US, British investors actually have more to gain from passive than their American counterparts. That's because fund management charges are higher here in Britain than they are in the States. No wonder the move away from active fund management is starting to gain momentum on this side of the Atlantic.
As company pension schemes become less popular, investors are forced to do it for themselves, so they need to be more and more aware that the low charges associated with, say, passive investment will ultimately, over very long periods of time, benefit them considerably relative to being with active fund managers.
So, to summarise, passive investing is not so much a theory as a matter of mathematical fact. There's a wealth of evidence supporting it, including the work of Nobel Prize-winning economists. And studies have consistently shown that when costs are factored in, passive investing produces better returns than active. Of course, one of the golden rules of investing is not to put all your eggs in one basket. And the cheapest and most effective way to diversify is to invest passively. Why pin your hopes on the shares of just a handful of companies when for less money you can spread your risk by taking a stake in the entire market?
So there's a return advantage to passive investing, and then I also think there's a risk advantage in that when you're investing passively, you're basically trying to capture market returns. So you are not going to be surprised by your investment manager's underperformance, or you're not going to be heavily concentrated in a few number of securities where the risk would be that if those securities do poorly, that your results will be very bad.
There's a rule in real estate that the three most important things are location, location, location. Well, my rule in investments, the three most important things are diversify, 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 and then I'll give you three more: keep costs low, keep costs low, keep costs low. And the simplest way of doing that is a very broadly diversified, very low-cost index fund.
Active fund managers like to give the impression their funds do spread the risk you're taking. But while index funds often hold hundreds or even thousands of stocks, a typical managed fund will only hold around 50. So if you choose an active fund, you're opting for greater volatility and you're paying a premium for the privilege.
If you go overboard on active management, you will end up putting your money in too few baskets. You'll be undiversified. So you get very excited by tech stocks, or you get very excited by commodity stocks. So you put a lot of your portfolio into that. And if you do that, by concentrating your portfolio on certain areas of the market, you pick up a lot more risk than if you have a better balanced portfolio.
Depends how you sort of judge risk, but at the end of the day, you don't want all your investments to be invested in the FTSE 100. Equally, people don't want to have all their wealth in the house that they own. And if you use a number of passive investments, you lower the cost of that investment to you as an investor, and cost is a big drag on investors' performance over a 10 to 20 year term.
Active fund managers do offer more genuinely diversified investments. Recent years have seen a proliferation of so-called balanced, cautious and defensive funds, as well as funds of funds. But the charges on these funds are even higher. Among the most expensive funds of all are what are called absolute return funds, which are supposed to provide the investor with some sort of return whatever happens, but in reality often don't. Not only does the passive approach offer diversification within a fund, it also allows you to buy entire asset classes. There are index funds for virtually every type of asset, whether it's European equities, commodities or UK gilts. And even when you put your money into riskier assets, you're still spreading your risk by buying the whole market. To find out how investing passively can help you reap the higher rewards of riskier assets while smoothing out some of the volatility, I visited Austin, Texas. This is home to Dimensional, a passive investment company specialising in investing in small companies and so-called value stocks.
When we first started, people said, look, all this tests on market efficiency, all these tests were done on large cap managers because there weren't any small cap managers. So we feel confident that in the small cap area, that's the area where they'll be able to add value. But if you look at our evidence over the last 30 years, there are very few small cap funds that have done as well as we have in terms of performance.
If you ask people where active management works the best, the advocates of active management often cite the so-called under-researched or illiquid or unusual asset classes, small companies, emerging stock markets, and that seems plausible to many people. Well, if we look for the last 10 years, for example, at least among U.S. registered equity funds, putting aside sector funds like those just investing in gold or just investing in one single country like Russia, if we look at diversified equity mutual funds, the best performing mutual fund is an emerging markets value fund. all the active money managers are out there. They could have bought these same securities, several thousand of them that comprise this dimension of risk and return, but for whatever reason they chose not to. So it was a passive emerging markets fund focusing on this value risk dimension that, as it turned out, had the highest return among all diversified equity funds for that 10-year period.
An argument often put forward by proponents of active fund management is that when asset prices fall, they often do so across the board. True, an index fund tracking, say, the FTSE 100 will rise and fall in direct correlation with the index itself. But despite the disappointing performance of equities since 1999, a passive investor would still be sitting on a sizable profit now, as long as they'd spread their investments, particularly when dividends are taken into account. On average, they'd also be better off than if they'd put their money into actively managed funds. And so, to that other golden rule of investing, always take the long-term view.
Best thing anybody who's going to be an investor could do is to spend a fair amount of time, 4, 5, 6 weekends, reading past issues of newspapers. Start with the 1930s, then read the 1940s, then read the 1950s, and keep on going until you have the feeling, gee, I really know a lot about markets. Then the main thing I'm learning is the data that's presented and the stories that are written up don't really have much significance over the long, long run.
The remarkable thing about finance is you cannot predict at all what the market is going to do tomorrow, but you can predict with reasonable accuracy what the return, at least of some asset classes, is going to be over very long periods of time. You might look at the past 10 years and say, well, it's been a lost decade. U.S. equities have had, over, depending upon the 10-year period you measure, about a zero return. But there are other things that have done quite well. Now, that doesn't mean that that pattern is going to continue into the future. In fact, I can guarantee you that that particular pattern won't occur into the future. It'll be a different pattern of returns. But the point is, if you own all of those asset classes, you won't screw up. You won't make up any big mistakes.
So let's summarise. Investing passively is the cheapest and most effective way to spread your risk. Because their holdings are restricted to a relatively small number of stocks, active equity funds are more volatile than passive ones. Active fund managers charge a premium for funds that invest in more than one asset class. And over the longer term, once charges are taken into account, the passive investor will always fare better than the average active investor. Let's look now at the impact of investing on our general health and well-being. Time and again, surveys have shown money is the single biggest cause of stress in the Western world. We worry about it more than health or relationships. Recent economic woes have only served to increase the pressure on everyone to spend and invest what money they have as wisely as possible.
Investing, or anything really which involves reward, activates pathways in the brain which secrete pleasure chemicals, what we call endorphins. So when you're feeling a bit of a high or a buzz from having anticipated a reward or thinking about you're going to make some money, you're going to get a very good rush of these pleasure chemicals in the brain. What happens is that people get almost addicted to that rush and they want to get more and more of it. But the downside of it, of course, is when they lose money or things don't turn out as planned, there can be a huge dip in the feelings and in the chemicals that are secreted in the brain.
I'm thinking of someone I saw quite recently, and in fact he hadn't told his wife about, some of his investments. And I mean, they're going to have to sell the house, kids' education is going to be affected, and I think the marriage is really seriously under threat now. Because this guy wasn't very sort of upfront about what he'd been doing. He thought investing was going to be a solution to many of the problems he was experiencing, but in fact it wasn't a solution, it's become a huge problem.
We've already established how passive investing is better for you financially in the long term, but it can also spare you unnecessary stress. Of course, financial markets are bound to go up and down, but as long as you've taken care to spread your risk across different asset classes, there's no need at all for your mood to go up and down with them.
With the active path, there's always a self-doubt. I knew I should have done this. I knew I should have gone out there. There is a certain transformational experience that goes on with accepting the notion of market efficiency, which it gets to be, let's call it an aha moment, where people go, aha, that's the way markets work. And once that happens, they're much more accepting of the fact that markets go up and go down. I mean, they always have and they always will. And there's, it leads to a better overall experience. And where experience to me means more than just having better returns. It's a better lifestyle as well.
I think passive investing is a good lifestyle choice because as far as I'm concerned, money is something that supports your life. It's not something you should be thinking about, worrying about, fearing about, racing after all the time. It's something that should be kept in its place, underneath you. And the great thing about passive investing is it works. And all you need to do is put your money in, ideally wrapped in an ISA if you can, or put in a SIP or whatever, and leave it there.
The beauty of passive is that because it's a rational approach rooted in mathematics, it takes the emotion out of investing. Emotion, you see, can seriously damage your wealth.
It is human emotion, it's behaviour that drives stock markets up and down. Take away that sort of irrational behaviour, as it were, and you get a more sort of sensible level of investing, which is the way most people invest. They invest over time, 5, 10, 20 years.
Well, we have to remember that the media doesn't like neutral stories. They only like the rather extreme stories. So it's easy to get swayed by the media. And of course, men are avid readers of financial pages, and we know that women aren't. And there may be something in that because men also are more likely to react to what they read, to talk about it again with perhaps peers and colleagues, and to feel that they have to act upon it. And I think the secret of the good investor is probably to be able to tune out a lot of what goes on in the media because it probably isn't particularly useful.
We tend to want to be in tune with the people around us because human beings are such social creatures. And again, the reason for that is evolutionary. And so when everyone else is buying, we tend to want to buy. When everyone else is selling, we want to tend to sell. And that means two things. It means that markets can be very unstable. If everybody's buying at the same time and then it turns around on a dime and everybody starts selling at the same time, you get a great deal of volatility. And then you also wind up doing the wrong thing at the wrong time.
By constantly buying and selling the funds or buying and selling individual stock, that ratchets up the costs even more. Our philosophy is you rebalance according to the way the portfolio should be sitting. So what I mean by that, if you're supposed to hold 40% in equities and 60% bonds, and it goes to 50-50 or 30-70, that triggers a rebalance. And the beautiful thing about rebalancing based on percentages, it takes away the emotion.
I think a passive approach to investing is a way of protecting yourself against some of this unnecessary stress that people get from over-churning, over-monitoring their investments. So really, a good plan that's only visited perhaps by an annual review will be enough, and you can spend the rest of your time enjoying your life and doing things that are less stressful.
So, to sum up, money worries in general and poor investment decisions in particular are major causes of stress. Rational analysis produces sensible investment decisions, emotions lead to bad ones. And for better returns, stop fretting about your investments and enjoy life. An annual review is all you need. You might be thinking this all sounds just too good to be true. Passive costs you less money, and yet it offers you ultimate diversification. It's good for your health and ultimately your wealth. But if passive really is superior to active in so many ways, why aren't more people doing it? Let's find out. Perhaps the single biggest reason why active still holds sway is the fund management industry itself. It's a powerful sector with a vested interest in maintaining the status quo.
When you have a market that's $1 trillion, And they're able to scrape off $20 billion a year or 2% per year from that to feed themselves. They don't want to give that up. So there's an awful lot of marketing and a lot of convincing of the public that they need active managers, that they need to pay 2% per year. It's all about keeping the money in the pockets of the people who are creating the funds as opposed to putting the money in the pockets of the people who are taking the risk.
Of course, the industry spends vast amounts on advertising. The news media might also play a part in making us invest the way we do.
There is quite a bit of evidence that when you're dealing with very complex issues such as investing, that the complexity is so severe that people end up just going with quick hunches. And you have a whole industry out there, the finance industry, that is built on it's built on an illusion that that there's a free lunch out there. That's what you're being sold every day in the magazines, because a magazine can't make money saying, you should be passive and do the same this year as you did last year.
We could have an article week after week after week telling people, passive investing, that's the way to go. That story gets old. There's no news here. Versus, I'm trying to write an investment story. This week, I have this really beautiful, articulate woman who's got a strategy. Next week, I've got this really handsome, outgoing, gregarious guy who has a strategy. They all make the cover of my magazine, makes it much more interesting. Versus me, put me on the cover, you're not selling anything.
There's another explanation, I think, which is overconfidence. There is a mountain of literature from the psychological field explaining that people, for whatever reason, exhibit this persistent behavioral characteristic. We tend to think we know more than we do. We think it's easier to see the future than it actually is. And it's fairly straightforward to document this. What's more interesting is that the research also tends to show that even when you point out these behavioral biases to people, they continue to engage in it.
I think passive investing is less popular than using active managers because in many ways it seems inherently defeatist. It's almost saying, I don't possess the skills to select a superior manager, that it's impossible to beat the benchmark, so why even try? I think this almost defeatist angle really turns some people off to the idea of passive investing, because after all, we all ultimately believe that we're exceptional.
Even with the knowledge, that passive investing is better, a lot of people still won't adopt it because they like to think they can do better. It's human nature. Everybody thinks they're a better than average driver. And in the same way, they think that they can pick a fund better than anybody else.
For others, the main reason why active investing is still far more popular than passive is a simple lack of awareness among the general population.
Primarily, I would say it's a lack of education. But then secondly, passive funds, because they don't make much money for the financial companies, while they do make money for us, they're really not promoted.
People are simply confused. Most people don't get the opportunity to hear that, active investing is clearly a negative sum game, just an adding up constraint, no science, just arithmetic. That's news to most people.
It's not about getting investment returns or superior returns above the rest of the market or beating our competitors. Our job is to educate the general public. And I do believe over the next 10 to 15 years, the general public will realise that the only way to have a successful investment experience is to own as much as the market as you can, be well diversified, and make sure that you sit in a really, really diverse portfolio with substantially reduced charges.
In summary then, the largely self-regulated fund management industry has a vested interest in maintaining the status quo. Human beings have a tendency towards overconfidence, and that's reflected in the way we invest. And while active funds are widely advertised, passive funds aren't, and nor do they command much media attention. So what does the future hold for the passive approach when fund management companies are spending vast amounts of our money trying to convince us that active is best? Can passive really challenge that perception people have that if only they find the right manager, they will beat the market? Well, actually, passive has been growing in popularity in the United States for many years, and all the signs are that it's starting to take off here in Britain as well. When a company called Vanguard introduced the first index fund for individual investors in 1976, critics said it wouldn't catch on. It's now one of America's largest investment companies with more than $1.5 trillion of assets under management, and it's expanding worldwide.
When we first opened our London office in 2009, we had 3 employees there. And I think in the first couple of months, there were 100 different articles written about us coming to the UK. And I said that was the best press coverage per employee of anywhere in the world. And what it really underscored for us was, I think the British financial press saw, we call it the Vanguard effect. Bringing somebody like us into the market would put a much more focus on cost, diversification, quality of service, and so forth.
In fact, Vanguard believes that passive investing has far greater potential in the UK because the cost of active fund management is higher over here than it is in the US.
Investors in the UK are paying very high costs to gain exposure to the market. We're very excited about our opportunities to expand here because we think by offering a very low-cost way of gaining exposure to the marketplace will provide a great service to investors.
I think passive investing is going to it's going to go through one of these exponential growth periods. That's really our bet in the UK. I think it would not be surprising to me that if that's 7% of retail assets that are currently passively managed double in the next decade, that would not shock me at all.
Although passive still accounts for a very small share of the retail investment market, in other words, the market for individual investors, institutional investors already have 30% of their portfolios invested in passive funds.
The trend is definitely towards more money being invested in passive as investors become aware of the fact that performance over long periods of time is very good for passive funds and the costs are very low. And a very important ingredient of a good performance is the low cost. And the research has suggested that low cost is in fact a good predictor of future performance.
One of the companies helping individual investors to take advantage of the lower costs and higher than average returns offered by passive investing is Barnett Ravenscroft Wealth Management.
We got together and we decided that we needed to assess everything properly, and we took time out over a period of about 2 years. We were just looking through all the academic research that was available, and it became evident, after looking at what was out there, that the passive approach was best not only for Barnett Ravenscroft as a firm, but for all our clients.
I think for once we've actually got to say, what are we in this business for? It's to service the client and make sure that they're the ones that are successful. It's not about that client's got X amount of pounds, let's take that money, oh, and look at the benefit to us, look what we can charge them. If we can focus on giving the best investment experience, we'll keep the client for life, they'll work with us for life, they benefit, and indirectly we benefit.
There are also signs that the media is becoming more receptive to the arguments for passive investing. Several independent internet sites, which, unlike the financial press, don't rely on fund management companies for advertising revenue and can therefore say what they really think about active funds, are also starting to recommend it.
You've got more and more websites like mine, Money Magpie, and also, of course, The Motley Fool, which has promoted passive investing for years. And more, I would say, people who know are saying, actually, you're better off with passive funds. So that trickles down. It's like fashion, when the top people are saying the same thing and gradually they're moving in that direction. That does trickle down.
I'll forecast going forward, we'll see more and more of the money invested in the UK moving toward passive. The advantages are just too strong. As people become better informed, you see more and more people saying, I'm going to give it up. I have not succeeded in the past trying to invest actively. I'm going to give up trying to do that. I'm just going to go passive where I can be sure that that I will beat the average active investor.
There will always be a large number of people who are overconfident enough, a large number of participants who are overconfident enough that they'll try to beat the market. But at the same time, the pattern that you see and the trend that you see is of increasing passive management, particularly in this country. Assets are flowing away from active managers, away from stockbrokers, and they're flowing toward companies like Vanguard. They're flowing towards advisors who manage money passively. Where does it equilibrate out? I suspect 50-50 won't be far from it.
So, to summarise, passive investing has grown steadily in popularity in the United States since the 1970s and continues to do so. Passive already accounts for more than 30% of the institutional investment market in the UK. And increasingly, both financial advisors and independent experts are starting to recommend it to individual investors. In 1973, an American economist named Burton Malkiel wrote a book that's become a classic. It's called A Random Walk Down Wall Street. Now, although he backed it all up with detailed statistics, charts and studies, his argument is a simple one. You can't predict share prices. If you do manage to beat the market, it'll be more than likely down to luck. Even then, transaction costs will likely cancel out any extra returns you make. As for picking the next star fund manager, you might as well forget it. To quote the author himself, a blindfolded chimpanzee throwing darts at the stock pages could select stocks as well as the experts. In the intervening 30 years, the fund management industry has poured scorn on Malkiel's theory. But no one so far has managed to disprove it. Now in his 70s, very wealthy, Malkiel is more convinced than ever that passive investing is the rational choice for every investor.
Every time I do a new edition, the 10th just came out, I ask myself, is the hypothesis true? Do index funds outperform? And every time I do it, I find that index funds do better than about 2/3 of the actively managed funds. And then, when I look at it in the next period, I find exactly the same thing, and the 1/3 that beat the index in one period aren't the same 1/3 that beat the index in the second period.
In fact, despite there being a wealth of evidence in favour of passive investing, produced by some of the world's most distinguished economists and statisticians, the intellectual case for active investing has been almost non-existent. Active's most vehement supporters are fund managers themselves, i.e. those who earn a very comfortable living from it.
I find, as a generalization, most active money managers have little interest in these debates. If they're involved in a debate at all, they simply point to people who have been successful at managing money and say this is proof that active management works. Well, it isn't proof because it doesn't demonstrate that the results are any better than luck, but it's the best they can come up with.
One former active manager who converted to passive says many active managers privately admit that passive makes much more sense.
When I converted over to passive and I started writing about index funds and how my peers are going to have a very difficult time beating the market, and here are the statistics and here are the data, I can't say that I was invited to any more parties. I can't say that I was shunned because I could show up to the parties just because I was part of the group, but I wasn't invited anymore. Now, I will also say, though, that one-on-one with my peers, in a private setting where nobody could hear the conversation, they would readily admit that it was very difficult for them to beat the market and that they personally believed in what I was doing.
And this is what Warren Buffett, the world's most successful active manager, says about passive investing. most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees.
I particularly like the fact with passive investing that you put your money in, and if you're sensible, you don't even think about it more than once a year. That's what I've done, and that's what I recommend to people who don't have the time or the interest to spend a lot of time in front of screens, learning about companies, learning about sectors, reading company reports, etc. I don't have that time, and I'm working in money. I don't have that interest. If you do have the interest, really to spend the amount of time that you need to, the kind of time that Warren Buffett, for example, spends, then sure. But on the whole, for most people who have lives, who have jobs, who have families, passive investing makes perfect sense. And having mentioned Warren Buffett, he thinks the same. So, hey, can't be that bad, eh?
Of course, the passive approach doesn't guarantee big returns, no matter how long your timescale. But even in turbulent economic times such as these, a balanced, passively managed portfolio, carefully weighted to match your own emotional tolerance of risk, does guarantee something even more valuable than that: peace of mind.
People often ask me, with regards to our clients, do they contact me with worry about what's going on? The answer to that is no, they don't. Because when I say they join a program, our job is to educate. Once they've been on the program for 12 to 18 months, they are probably better armed to actually know more about investment management than probably 60 to 70% of the financial advisors and some of the fund managers.
Now, you may have noticed that we've deliberately avoided singling out specific fund management companies for criticism. As long as you read the small print, you can see for yourself how much each company charges, and it's easy enough to find out whether they really do deliver the returns they say they can. But we did ask the industry regulator, the Financial Services Authority, for an interview. This was its response.
Unfortunately, we will have to decline your request to participate in the programme. The FSA has strict rules about being seen to endorse a particular firm, and that will prevent us from participating.
Indeed, this film has been funded by a company that specialises in passive investing. But given all the advertising for actively managed funds that we're constantly bombarded with, also privately funded of course, using customers' money, you could say it's about time that someone redressed the balance. So you've heard the main reasons why we think the fund management industry is letting investors down, and why a passive investment portfolio is the right solution for the vast majority of investors. But don't just take our word for it. Why not investigate a little further? It won't take long, nor will it cost much, if anything at all. But financially at least, it might just be the best investment you'll ever make.
I think with a lot of investors who go into the passive investing side and go into the indexing side, it's a road of self-discovery. So something sparks them to start looking into it. And once you start looking into it and you read a book and it leads to another website, it leads to another video, and all of a sudden you have like what I had, which is a chemical reaction. And you say, I get it.